Hi, this is Peter Walker. I'm CEO of World Capital Management, and today I'm going to talk about a professional's guide to stock market investing. I will tell you everything you need to know about how to create stock market portfolios for maximum growth. So let's get started. This video is really for institutional money managers who want to have better returns. I have an investment software tool that automatically builds better performing investment indexes. This software is intended to be used by institutional money managers seeking a totally integrated, easy to use, market liquid, all-in-one investment management solution. That's quite a bit to promise, but I'll show you how that is done. Just to give you a little background, back in 1986, I started putting together a database of private money managers from around the country. So this is probably the oldest and possibly the biggest database of private money managers, and the intention was to find out which of these managers had the best long-term investment performance, because I was interested in knowing whether there was a particular strategy out there that worked well consistently over the long term. I initially started out in printed format, and then I went to an online format. In the online format, you can find it at managerreview.com, or you can Google Money Manager Review, or you can give me a call and I'd be more than happy to give you a tour. Today I want to talk about money management and show you a style that I believe is better than the others. And I've looked at over 2,500 money managers over the 35 years that I've been looking at performance, and over 10,000 investment composites, so I consider myself a little bit more knowledgeable about this than most people in Wall Street. So just to start here, money managers can be divided into two very broad categories. These categories are either considered active or passive style managers. So there's a big difference between the two, and it really has to do with the way they measure the stock market. Active managers make investment decisions based on a company's anticipated future share price. In other words, they look at the price today and they determine whether it's undervalued relative to other stocks, and then they project in the future what that potential price target might be. Now, that's considerably different than what the passive managers do. The passive managers, which are generally called indexers, are making their investments based on capital market size. That's the difference. One looks at the anticipation of price changes. The others look at capital size as being the basis of how they do their investments. How do the two compare? In other words, if I have a portfolio and I think I'm going to put my money with a money manager, which style should I be going with? Generally speaking, this is what the data shows us. This is a 25-year study. It's Bloomberg Morningstar that put it together, and it's comparing the active managers, which are in the right line, with the indexers, or the passive managers, which is the line on the top. And as you can see, there's a very clear difference in that the indexers are doing far better than the active managers. Let's look at where the money is being put as far as management. It used to be that there were very few indexers. Everything was done on an active management basis. Over time, you can see that money is being taken away from the active managers, and that money seems to be going to the indexers. This all started about year 2000. Indexes became more and more popular. Between the two strategies, it's the indexers that are now being favored. Let's look at indexes. How are they actually measure capital, the basis of their determination as to how they allocate money? So this is how stock indexes are calculated. A company's capital value is calculated by multiplying the current price of a company's stock by the total number of outstanding shares. These circles here represent the sizes of the companies based on those two criteria, the stock price and the number of shares. This large green circle here represents the total values of all the separate companies. So an index's total capital value is the sum of the capital values of all the companies in the index. An index is really reporting changes in the capital size of all the companies in the index. Let's look at two of the biggest indexes in the market. The biggest one is in the red here, and that's the S&P 500. It represents about 80% of the total values of all the companies on the stock market. The blue value line here is the NASDAQ 100, and that is second largest, and it's favored by people that want more growth with their portfolio. The important thing here is to notice that the difference is based on the capital growth rate. So in other words, we can clearly see here that what makes a difference in the performance between these two indexes is how fast their overall capital growth rates are growing. The NASDAQ 100 index has been growing faster than the S&P index because the NASDAQ 100 index includes companies with faster capital growth rates. And because faster growing indexes are made up of companies with faster capital growth rates, it follows that it's possible to therefore design indexes with better investment returns. In other words, all we have to do is figure out which of these companies have the fastest capital growth rates and then put them together in a new capital weighted index. So that's the key, and that's what I'm about to show you how to do here. So this is my first example. Here is the top 50 largest companies sorted by capital size. So we talked about the difference in terms of performance. So we're going to take these top 50. If we sort them by their capital growth rates, what do they look like? So here's the bottom, about 2/3 in terms of their 1-year growth rate. So it's a negative almost 7%. And here's the top 1/3. It's up about 18%, which is about a 25% difference, which is pretty major here. So if we're going to look at these and put them together by growth, what we want to do is to figure out these top third of the 50 that we are looking at here. So how can we automatically create indexes using companies with fast capital growth rates? The solution is using the following software tool. Here it is. This is what it looks like. So what we have here are a number of indicators, and this is all in one place, and this also will allow us to make the necessary adjustments to come up with the optimized index that we want. Okay, so now we're looking at it hooked up to the market. This is the 50 companies in this. You can see them all listed there. And the way this works is out of this 50, we want to figure out which of the ones have the fastest capital growth rate. So to do that, we just go up here to this scroll bar and we start pulling it to the right. Now there are algorithms here that are automatically going to do all the calculations. And what it's doing is it's taking out the companies that have slower capital growth rates and it's leaving the ones in with the fastest capital growth rate. So I'm going to bring this down to about 20 stocks. Okay, we're down to about 21 stocks. Here we go. This is 20 stocks, and you'll notice everything updates in real time. Everything's done automatically. Everything is interconnected. The symbols are here, and these are the weights here. What we've done is we've isolated the companies with the fastest growth rates, and within those companies that we isolate, we then put them together on a capital weighted basis. So this is the way it looks. This is the company distribution. This is the industry distribution. This is the 1-year performance between the two groups, and that's how simple it is. I mean, it can't be simpler. This is hooked up to the market. All the data is current. You're getting the most recent data, and then you have the tools here to make this analysis. Let's say you want to make some adjustments. Let's say you decide the volatility is a little bit high. Well, we have another scroll bar for volatility, so I can pull this over using the scroll bar, and I can reduce the volatility of this portfolio. So here I've just reduced it quite a bit. It automatically goes in and takes out the companies with the higher volatilities and leaves a new portfolio, new allocation. Now, let's say we decide that the allocations are too big here. For instance, here, notice the pie chart, there's a large allocation in one position, and we want to limit the maximum amount. So what we can do is go over here, and we can put a maximum amount of our allocation in here, and that will make the largest position whatever that percentage is, and then it will redistribute that excess, and that will then be redistributed evenly to all the other positions. So if we want to adjust that, it's very easy to do. Another thing we can do is we can take out a particular company. Let's say we decide that we don't want a particular company in our index. So we can just click on an icon, and that will take that company out. It will then readjust everything. And then if we wanted to add it back in, we can click on it. So if we want to add or take out companies, it's that simple. Now, if we wanted to see what Wall Street thinks in terms of the earnings growth, or we want to see the 10-year history of the stock, or you want to see the balance sheet of the, if I click on a particular company's icon, which is right here, this is looking at everything on a 1-year basis. Let's say we want to look at it over a 24-month period. All I have to do is to adjust it for 24 months. I have the 24-month growth rates here. And so here I have a portfolio with 26 of the fastest growing companies by capital size. So I can adjust this again to whatever I want in terms of the number of issues and the diversification. One thing I look at is the total capital market size of the index. So when I adjust this, generally what I want to do is adjust it so the index has a maximum capital size to it for diversification purposes. This does a very good job with that optimized balance between capital size of the portfolio and the growth rates. Over here, we can look at the time period. Let's look at a 1-month distribution as far as the market. So this is the way it looks for 1 month. So I can go short term, I can go long. If I want to look at the growth trends of capital for these companies over a period of 1, 3, 5, 6, 9, 12, 18, and 24 months, I can do it just by this pull down right here. Finally, once I get the portfolio I've decided is optimized, what I can do is I can single click order entry system. Okay, so I click on this and one icon, and it'll look all the stocks here by symbol and by weight, and it will automatically format it, put it into a file. I then take that file, I upload it to the brokerage firm. The brokerage firm then has everything it needs to go ahead and implement my order. So it's a one-click order system. That's done automatically. What you have here, again, just to summarize, is a system that's hooked up to the market. It has all the algorithms to put together a portfolio that is optimized, and you have the adjustments there in case you want to sort of fine-tune it a little bit. It's all built in, and it's obviously very easy to use, and it's highly automated. That's the end of the presentation. I'll just finish here. Let me present this just before we go. This is an actual portfolio. This is the first portfolio I put together. It has the longest history. This was put together about 3 years ago. I had it with a brokerage firm for 1 year. The performance was great, but the brokerage firm went out of business, so I wasn't able to extend this chart to include it going forward, but this is about 2.5 years showing the performance of that portfolio and how it compares with the major indexes. As you can see, this portfolio has done extremely well. That's the performance in the dark blue, and then the light blue is the NASDAQ, and the red is the S&P 500. So I've used this for a number of portfolios. This can be used really for any index that you want. If you want to improve investment performance, you need a powerful analytical tool that automatically creates indexes that have maximum capital growth. Our software is specifically designed to build fast capital growth indexes. If you want more information, call me, Peter Walker. Here's my contact information. Here's a little bit more information about myself. Here is the email address. Here is the website. Here's my telephone number. If you want to call, I can give you a live demonstration. I'll answer any questions you might have about it. Again, if you're an institutional money manager, I've designed it specifically to make it easy for money managers to manage large portfolios. With that, I thank you very much. Again, this is Peter Walker.